Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit the subscribe button. Now let's kick off with the latest economic developments. In the United States, producer prices rose by 0.2%, driven by a rebound in service costs, while jobless claims climbed to 230,000. That's higher than expectations and indicating a continued softening in the labor market. Now, investors are watching closely as the Federal Reserve prepares for its next meeting, with the market still expecting a 25 basis point rate cut, despite lingering inflationary pressures. Meanwhile, across the Atlantic, the European Central Bank made its second rate cut this year, lowering the deposit rate to 3.5% as inflation in the Eurozone cools to 2%. However, sluggish economies like France and Germany raises concerns about whether these cuts will be enough to jumpstart the economy. ECB President Christine Lagarde emphasized that future policy will remain quote, data dependent, particularly as wage growth continues to add to inflationary pressures. Now, with these developments, we're also seeing spot gold rally to a new all-time high, breaking past that 25.50 U.S. mark on the spot, of course, as investors flock towards safe haven assets with all this global economic uncertainty. So let's break down what this all means. I'm joined by Mohit Mittal. He's a senior director of sell-side research and operations at Acuity Knowledge Partners. Now, Mohit provides deep research to major institutions and investors. And thanks for making the time. Welcome to Kitco.
Looking forward to speaking with you.
Okay, let's jump into this, Mohit. There's lots to get to. I know it's quite late where you are. Of course, we always appreciate you making the time. You know, U.S. producer prices rose that 0.2%, as I mentioned. Jobless claims ticked up to 230,000. Given this, how do you see these trends impacting U.S. equities, particularly with the S&P up significantly year to date?
Well, Jeremy, the PPI came out, the labor, data came out, but in reality, there's nothing different than what we were expecting, right? About the jobless claims which came out, it's just 2,000 more than what was expected. So it's broadly in line with what the market is expecting. Of course, S&P is really high, but it has seen a lot of volatility. And tech has dominated that volatility. Tech has dominated the increase in S&P this year, and looks like that's what is going to take it ahead as well in the future.
Yeah, I mean, the market certainly rallied back yesterday after a market sell-off. Are investors underestimating the potential risks of an economic slowdown if things potentially get worse here, Mittal?
So that's the thing. So there are two thoughts here. One is that should we be cutting more than 25 basis points next week, or should we even not cut beyond 25 basis points? And two school of thoughts are based on where the economy stands now. Economy looks like it is slowing down, but I cannot say it's falling. The labor market still stands great. If you compare it with the 2 years back, we still have good numbers there. The unemployment rate is still stuck at around 4.2%. It's not necessarily increasing quite a lot. So yes, there is slowdown in the economy, but are we seeing completely falling off the cliff? Is not necessarily happening. And just one more thing to notice, we are all talking about Fed rate to go down. But if you look at the yields have already declined in expectation of Fed rates cutting. So which means that not completely, but there is definitely some passing of yields slowing down, going to the economy. For example, mortgage rates are at 2 to 3 years low, right, at around 6%. So definitely some aspects are getting cooled off, and economy may not be as bad as some people expect. At least I don't expect it to be that bad.
Yeah, interesting. Okay, talk to me specifically about those U.S. equities then. I mean, I saw Nvidia's CEO, Jensen Huang, this morning. He was saying that this is the new industrial revolution out there. And some argue, that future earnings won't be able to keep up here. What are your thoughts? Are we over-evaluated, or is this going to continue to be a hot market for the S&P?
Well, we need to look at it from two aspects. Number one is we are all talking about Nvidia. And what about the broader market? So maybe first we talk about Nvidia, Jeremy. So Nvidia has been doing very well. The numbers every quarter have been fantastic. It has also seen that volatility. Imagine $1 trillion market cap company and going up and down within a span of 1 month around 20%. So it's not necessarily healthy for the markets, but that's where it is going. I feel the impact of AI is not necessarily a frenzy. just like what internet boom was perhaps in the late 90s, because the application of AI is widespread across not just tech companies, but across all the companies across different sectors. And there is earnings, there is revenue, which is hard numbers are there in Nvidia and other earnings, which we have. So Nvidia's story is looks like it's going to continue, or rather tech story or AI story, it seems, is going to continue. Now, if you move towards the broader market, and that's where the meat is, and that's where perhaps the Fed policy rate is going to impact. We have definitely seen in the last 3-4 months, the broader market, the Russell 2000 came into play, still not up more than 5% in this year, but definitely came into play with expectations of Fed cutting rates. And if Fed does cut rates or continue to cut rates in the coming cycles, it might get impacted, but it doesn't look like that there'll be a lot of meat coming out of the smaller companies. The Russell 2000 still going to be the large caps which will drive it.
Yeah, lots of interesting times to come there, of course. Okay, let's switch over, go across the pond. The ECB just made its second rate cut of the year, bringing the rate down to 3.5%. You know, inflation seems to be moving towards that 2%, but there's major economies like Germany and France that are really slowing down here. How do you think this will affect, European equities and I guess more specifically, that market in terms of economic growth in the EU?
Well, Christine Lagarde gave a wonderful press conference today, but I cannot even imagine what she's going under her skin in her head, because it's really a peculiar situation, right? I mean, ECB has always been a single mandate bank. They're only looking at inflation, and that's what they're trying to control, but the growth is not necessarily there. And if we talk about not just EU, but if we look at UK as well, UK has flattened growth, 0% in the last 2-3 months that has come out. So Germany, France, both are not looking so good. I think France has a little bit of Olympic boost, if we call it that. But Germany definitely is in shambles, if we say so. Car market, automotive market overall, manufacturing activities completely down. So it looks like it's going to be hard times ahead for the Euro region, particularly what my read is from Christine Lagarde's press conference is that we are not expecting another rate cut coming in the next meeting.
Yeah, interesting. Okay, so considering the growth forecasts of 2024 and beyond were revised down, do you think the European markets might have a downturn, even with the rate cut that they did today? I mean, are there any sectors that you're looking at that might outperform in this environment?
Very difficult to say, actually, because oil prices are also declined, though it is up for the last 2-3 days, but definitely a decline from the 78, 80 levels to around 68, 70 levels. So that should provide some respite overall to the economy there. But if you look at the spending overall, it's not necessarily happening in the manufacturing side. On the other side, the services sector, particularly the holidays, the insurance, basically those are the sectors perhaps we can look at to go into. But Jeremy, to be very honest, at this stage in this economy, it's not really about sectors. It's necessarily about the good companies. Look for companies which have lesser debt, companies which are maybe able to pass on some of the inflation, as we know, which is sticky still. Those are the companies maybe to look for rather than specific sectors.
Yeah. Is there anything that you can say here in terms of some of those recommendations, or is there any specific equities or areas that you're looking at here?
We don't do we don't do specific company recommendations.
Okay. I want to switch over to gold. I mean, it's been a heck of a year for gold, and we saw that new all-time high today on the prices. We're clearly seeing investors returning to safe haven assets. As I continue to look at other networks, here at Kitco News, we love talking about gold, so we'll cover it. But the other news networks aren't really covering this new asset this new all-time high of course, gold. So I want to talk to you a little bit about this. Inflation's cooling, global equities have remained relatively strong. What's driving this renewed interest?
Well, to your first comment, Jeremy, I think others have missed the bus, and you guys are doing a great job of covering gold because it has given stupendous returns over the last 2 years or so. And particularly even this year, it's up 20%. So there's a lot happening in gold. Now, what is ahead of us when it comes to gold prices, especially after today? It has, I've been reading the technical 2550 levels it has broken today. So it has to be seen what will happen. What is important is that the market, usually the momentum trade is about whether Fed is reducing rates, like ECB reduced rate today, and we saw versus euros, the gold really went up. The trade about the inflation is there, but what is necessarily driving is the buying coming in from central banks. It's more of this office buying is what is driving. We saw Russia came up with a program 2 months back again to increase those buying. And this is a trend which is likely to continue, given the macro volatility happening overall in the globe, and also very much driven by US, given the fiscal deficit, the logjams in the Senate, which is likely to happen even if the presidential election goes either ways. So this is something which is likely to continue. And the central banks, is especially China, India, Turkey, Poland, even Russia for that matter, has a lot of appetite to increase the percent. And I think India, China, Poland are still less than 10% of their reserves are in gold, in comparison to US, which is somewhere around 70% plus. So there's definitely a lot of appetite which is going to drive this further, in my opinion.
Yeah, interesting. Okay, so I guess the question is how much further? I mean, you mentioned there, the World Gold Council came out with the reports. We know that central banks have been buying gold. We've also received the news that, for the past 4 months out of China, they've paused with their central bank buying. Again, that's Chinese information that I can't really confirm, unfortunately. So I'm kind of curious, some might argue that gold's rally is being driven by this whole fear of a long-term slowdown, but then we're seeing inflows in the ETF side too. So is this, investors just positioning more defensively? Do you expect this trend to continue? What's it like on the ground there in India?
Well, from India perspective, India is definitely seeing a good demand. And if you look at the momentum trade in the next 3 months, you can expect gold to continue to remain on top of everybody's agenda. We are getting into the festival season, so we are expecting more and more demand for gold coming in, also with a lot of stability. So if last year at this time, when the gold prices increased quite a lot, there was a little bit of pullback on buying, but with the stability coming in and also the expectation of gold to remain high, the more buying is coming in from India and I think across the world. And look, in terms of the slowdown in the economy and what is the structural overall change which is happening, is it's also about the US positioning. And I'm more talking about soft power than the specific employment or GDP numbers. It's more about US positioning in the world. What we have seen in the last 4 years or maybe 5 to 6 years is US has not had that good command on the economies across the world. Israel is a good example. And yesterday, again, Biden came out and said that it is not good. Israel has to be more patient. Israel has to be more knowledgeable in terms of whom they are attacking, and their attacks are killing different people who should not get killed. So those are the things which are impacting the soft power US and making people to go and buy more and more gold. So let's see what's there in store, but interesting times ahead.
Yeah, interesting times ahead. As I mentioned, we've seen that uptick in the ETF inflows too, which has been very interesting because it almost seems like we see some Western investors just from a retail level coming back to the market. What's your take on how institutional investors are positioning themselves in this market?
No, so if you look at the data definitely suggests that more and more inflows are coming in the ETFs. And one is that it is just about popularity of these ETFs. There were not many ETFs. I can tell you about India. We did not really have a lot of ETFs on gold focus till like 2-3 years back, but there's a lot of interest there. So people are looking to park their money, and ETFs provide them a good option to do that, especially those which are physical gold backed. So people are definitely looking to do more. I feel that this is something which is going to continue. It may not be as growth rate oriented as it has been till now, but this is something which should likely continue given the overall macroeconomic environment that we're seeing in the global markets.
Yeah, Mohit, I mean, you obviously prepare these large reports for the institutions, larger investors. What's your outlook on gold when we talk about the precious metal? Give me your outlook towards the end of the year, especially with this election coming up and possibly, Q1. What are we going to see next year too?
Well, the outlook is driven by, again, the physical demand, which is happening through central banks, and then more of momentum trading, which is happening. Now, I feel that the momentum trade in terms of expectation of Fed rate cuts, etc., is broadly priced in. I know with every uptick which will happen or every decline with happening in the Fed rate, there might be a little bit of an uptick in the gold prices, but the real demand or real increase is going to come from the central banks continuing to buy gold. So I've looked at some of the estimates, some of our clients, some of our Wall Street firms are saying around $2,700 by the end of the year, which looks reasonable to me. But beyond that, it is time is going to tell if we go beyond that in Q1, Jeremy.
Yeah, there's been so many CEOs of mining companies that touch these precious metal prices. They're seeing this with the largest lift they've ever experienced. Yes, costs are up in the mining sector, but it hasn't touched their equity prices. Do you think institutions will start looking over here finally?
They should. Look, the cost has definitely moved up. I think around from 2021, cost has really gone up by around 40% or so. So definitely there has been a bigger floor for gold prices. I mean, we see gold prices for a long time at around $1,900 or so, and cost at that time was around $1,100 or around $1,000 per ton. So now it has gone up to around $1,400, $1,500 levels. So we definitely have a floor which has increased, and that should definitely drive more and more investors to come in. I feel investors are already there. The avenues of investment may be through ETFs, as we were discussing earlier, but there should be more coming in my opinion.
Yeah, it's been fascinating to watch these inflows on the ETF side as opposed to individual equities, but hopefully someone's getting the lift. All right, Mohit Mittal joining us. He's a Senior Director of Sell-Side Research and Operations at Acuity Knowledge Partners. Hey, thanks for this, Mohit. I really appreciate your time today. I hope you have a great week.
You too. Thank you.
All right, I'm Jerry Szafron, and for all of us here at Kitco News, thank you for tuning in. We got great content all week long, including next week. Lots of coverage of the Fed, and we'll continue to monitor these gold prices. We'll see you next time.